Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be host the October Macro Investing Masterclass with two distinguished capital markets experts, namely Patrick Armstrong, CIO at Plurimi Wealth, and Chris Watling, CEO of Longview Economics. So welcome, gents.
Yeah, hi there. Good to be here, Paul.
Yeah, well, lots been happening since we last spoke, not least the sort of hotter than expected US CPI, retail sales and jobs data. But the sort of like the only game in town has been the exponential rise in the yield of the 10-year Treasury to almost 5%. So maybe we can start there, Chris. What's been sort of driving this increase, despite so many people calling for a recession? And we've had that sort of like geopolitical risk with Israel and Hamas, which usually is associated with a flight to safety.
Yeah, I mean, great question. I mean, it really has been the sort of center of the action, the center of the debate in markets. I mean, to my mind, I think it's a blow off top, which is typically what you get in the last part of a sort of extended move that might take 2 or 3 years to play out. And if you think about US 10-year bond yields, they troughed back in August 2000, sort of March 2000 in the pandemic at around 0.5%. They've been going up ever since then. And the blow off top is generally what you have, as I say, at the end of that move, when all the sort of shorts or the longs, perhaps in this case, get squeezed out and you get dramatic price action in that final part of the move. So I kind of think that's where we're at. I know there are tons of other things people are talking about, you know, the Chinese selling, the Fed selling, the US Treasury selling. It seems like everyone's a seller of treasuries, which is not actually correct. Households are buying tons of the stuff. So the idea that everyone's a seller is not accurate. I just think it's that final part of the move that you see, and also people, of course, talk about the strong U.S. economy, which again I think is not going to be sustained. I do think the recession is coming, and I'm sure we'll get onto that. So yeah, I think there's an opportunity there. I think that's an opportunity with yields at this level.
What do you reckon there, Patrick? In terms, do you think the 10-year yield has topped out? I did see that Bill Ackman overnight tweeted that he's closed his short on treasuries. But
the two bills, Bill Gross as well, I think tweeted around the same
time. Okay,
but
a lot of people, certainly the fixed income guys, are talking about a positive term premium being built into the 2 and 10s at some point, around about a 1%. So if you get that on top of 5%, I mean, you are just arithmetically, you get a potential 6%. But what's your view? Do you think we've topped out at 5?
I think 5 is a pretty fair level. I think 4.6 to 5 is where we should be trading right now. So my view is the U.S. doesn't fall into a recession in the next 12 months. If I was expecting a recession, obviously I'd be buying yields right now. But typically, just before the Fed does get into a cutting cycle, the Fed's fund rate, the 10-year yield, and the 30-year yield all converge pretty close to the Fed's funds rate. So if you go back to 1980 and look at all the Fed cycles, you get a yield curve that's flat as a pancake, and that's pretty much where we got to yesterday. So I'm not short treasuries. I'm not long treasuries. What is compelling for me are the tips. 2.5% real yield over 10 years. You're going to grow your purchasing power by 25%. And it's still going to be a safe haven if we do fall into a recession. But for me, the bigger risk that I want to hedge against is basically populism, nationalism, protectionism, war. All of those create structurally higher prices, not because of demand growth, but just the benefits of globalization disappearing, leading to higher cost structures. I like to hedge that. And with a tip, you're growing your purchasing power by 2.5% every year for the next decade. I think that's where the real compelling yields are.
And just for the mechanics on that, for investors, are we saying if you've got a 2.5% or a 2.4% 10-year tips, so what basically the US Treasury is giving you 2.4% above what the CPI says for the next 10 years? Yep. Is that how it works?
Yeah. So if you look at the 10-year yield at 4.8, 4.9%, inflation swaps have about 2.4 to 2.5 for the next decade. That's where the break-even inflation is. So if inflation does have a period where it's running at 2 to 3 with intermittent spikes, with a tip, you're going to get the average inflation over the next 10 years. Your capital base is going to grow in line with inflation, plus you're going to get 2.5% every year for the next decade on top of whatever that inflation is. So if inflation does come in higher than those inflation swaps of around 2.4 for the next decade, you're much better off with a tip. And the budget deficits, the populism, spending money that you don't have, it's going to lead to an end game of monetization of debt. And I really think that the tip hedges you against those kind of risks that you get at the end of economic regimes. And we've just sold our gold to move into tips because I think it gives you the same safe haven characteristics, the same protection against monetization, same protection against inflation, but you get that yield that you can mathematically count on. You'd probably need gold to go up about 50-60% to break even with a tip over the next decade.
Brilliant. Well, that sounds like a really smart way of playing the sort of the long-term game. No doubt about it. Now, big welcome to Edmund Shing, CIO at BNP Paribas Wealth Management. So thanks for joining us there, Edmund. Now, I know I'm going to put you sort of straight on the spot here, so apologies for that. So we just talked about the sort of the yield on the 10-year Treasury hitting 5%, probably reaching a peak, but obviously we've got a lot of positive real yield. What does that mean for sort of like equities going forward? Because we've had a bit of a sell-off, and it hasn't really sort of like had capitulation yet. But is it just a repricing of that against fixed income, or is it something potentially more serious to think about? Oh, we've lost your voice. Sorry there, Edmund. We can't hear you yet.
There's a challenge. There
Exactly,
we go.
Yeah. Okay. Well,
Fantastic.
we'll come back to you, Edmund, in a moment. Chris, what in terms of the overall global economy, what does it sort of like mean next year? Because we've had spreads on sort of like, corporate debt still being fairly tight. High yields at sort of like the triple C's have ballooned out, admittedly, but nobody's sort of like calling for a big recession. But what's your sort of view?
Yeah, I mean, I think the recession call is very valid. I mean, there are lots of ways of thinking about it, but and let's remember, economics is a social science; it's not a science. So, it's not precise, it's not mathematical. It's there's a lot of judgment involved. And basically, if you look at the best indicators out there, and you can include the inversion of the yield curve, you can include leading economic indicators, you include all sorts of stuff. The majority of them, not all of them, the majority of them signal that a recession is quite likely. And then you wind that forward and you think about the timing of that recession. And of course, a lot of us thought it would be earlier this year. And frankly, I think it probably would have happened if we didn't have the banking crisis and the Fed did 500 billion.
Counterintuitive, isn't it?
It is completely counterintuitive. I completely accept that. But the reality is they printed a lot of money and backstopped all deposits, which was monetary policy working its way through the system. It just happened they didn't like the way monetary policy was working. So, but I think, one of the great ways of timing recessions is just to look at when the curve starts steepening up. And if you look at the yield curve today, look at 10s, 2s, it's been steepening very rapidly since July. And that's typically a pretty good indicator that you're about to go into a recession. So there's I think a lot of quant work you can do that suggests the evidence of recession is really quite high. And then you can do a ton of other stuff. You can look at what I call the stimulus cliff. There's been a ton of fiscal stimulus in the US this year. That's not going to be, the comps next year are going to be a lot harder, put it that way. There's been all these excess savings that we've had being run down in the States, and they are pretty much gone now. So, there's a ton of things that are telling you you're running out of stimulus. If you look in Europe and the UK, where there's been less stimulus, those economies are probably already in recession. UK employment is going down. The unemployment rate's going up. That's a pretty good sign you're in recession. Eurozone PMIs this morning are in recession territory. So they had less stimulus. They went into recession earlier. It seems likely to me that the US is going to go in, and it's going to go in the next few months, really, couple of quarters. So, yeah, I think it's happening. And the steepening up of the yield curve is a very good indicator that the timing is pretty close.
Okay, then let's try Edmund again. We'll tune in to see if we can hear him. What's if you put all that together with the 5-year, with the 10-year yield at almost 5%, and Chris has obviously got still a negative view. He keeps kicking the cap, that recession can down the road for another 6 months. What does all that mean for equities next year? Because we've certainly got the markets pricing in a sort of 10-12% increase in EPS in the US to around about 247, I think it is now, dollars per share.
Yeah, I think that's going to be tricky. I think it's going to be tricky. I mean, we're positive equities now, but I do anticipate at some point taking that down. And the reasons, as Chris pointed out, are obvious, that there will be economic weakness and that will translate, particularly in the US. I mean, in Europe, as Chris said, it's here. So there's no surprise there. The question is obviously whether analysts are still too bullish. And I think in particular in the US, the answer may well be yes. double-digit earnings growth next year is going to be a challenge at a time when a lot of the margin expansion of companies was done, of course, by repricing on the back of inflation. Well, okay, so let's assume that the inflation swaps may be a bit wrong, but not completely wrong, and that inflation continues down and doesn't flare up again. Well, in that case, companies are going to struggle to maintain that pricing power. Obviously, some will. The companies with the real pricing power will maintain that ability to raise prices, but it's not going to be such a universal quality. I think we've had a temporary, with this wave of inflation, we've had temporary pricing power in a number of sectors, but that clearly dissipates, I think, over next year, particularly with a slowdown in, at the very least, a sharp slowdown in economic activity.
Okay. Now, Patrick, in terms of sort of like, what's your view on the sort of the the equity market, and how have you sort of translated that into your sort of like asset allocation, other than obviously selling gold and buying tips?
Within equities, energy is our favorite sector, and I just think OPEC's shown a clear willingness to support prices at $80 a barrel. If prices do fall below that, OPEC is very relevant right now because supply and demand are very close to balance. There's a little bit more oil being consumed every day than there is being produced, and if demand does fall with slowing economic growth, OPEC's showing a willingness to cut. So I think they keep prices at $80 a barrel. You're also getting a geopolitical hedge against any supply disruption in the Middle East, increase in sanctions. It's obviously very plausible. 1973 type situation happens. We don't expect it to, but I like to hedge against those kind of scenarios as well. And companies just have massive cash flow. They're paying down debt, paying back big chunks of debt as well, paying dividends, buying back shares, and just very cheap on all the metrics we look at. So that's our preferred sector.
And what's the sort of what's been the trigger on the M&A of recently? Obviously, you've had Exxon buying Pioneer, and yesterday we had Chevron and Hess getting together.
Yeah, there's because the big companies haven't explored or developed for new reserves. To keep their production in line, they're going to have to buy reserves from somewhere else. And what we started buying is Canadian mid-cap oil companies. Those are the ones that are just the cheapest and natural acquisition targets. That the U.S. is talking about Venezuela curbing restrictions on them, getting their oil into the market, but it just makes so much more sense for the U.S. to pivot towards Canadian production, improve some pipelines, and these companies have no debt left to pay off probably in the next 12 months. If oil prices stay where they are, they can buy back their own shares. There can be management buyouts, or big companies are going to take them out. So that's the extreme valuations for me right now, is the mid-cap oil companies in Canada right now, just incredibly cheap.
It's a good mix, I must say. Well, I was going to say, Paul, I think it's a terrific mix, energy and mid caps. I mean, two areas of the global market that no one likes at all, that are incredibly cheap. I think the global energy sector is trading something like a 50% discount to what it normally trades at relative to the global market. And of course, mid caps, everyone hates them. It's classic late cycle play. Everyone kicks them out. No one wants to own them because they're much more economically sensitive. They're a much better barometer of where the global economy is going than the big caps, which have all sorts of peculiarities in them. So, and to the M&A point, I mean, it tells you, I mean, companies know these companies are cheap. They're very attractive. So of course they're buying them. I mean, it's a fantastic signal. Actually, it's another good reason to buy the UK market, frankly.
And just on that sort of like, the between the US integrated and the European integrated, does anybody know why they trade at different valuations? Because you've got Exxon and Chevron at about 11 times average PE, but Shell and BP are about 7. And they see, I know you've got a greater sort of like US exposure, perhaps the Permian, but
no, but that's actually true across sectors. If you were to take the UK as an example, across sectors, you see a discount of European sectors to the same US sector, so oil versus oil. And the UK is at a discount to Europe, so UK is at a double discount to the US, and that's across sectors. That's pharma, that's oil, that's everywhere. And I think partly that might be down to the UK investor, particularly pension funds, diversifying massively away from UK specific equity focus towards a global equity focus. And today, a global equity focus means 2/3 to 70% in the US. And of course, as a result of that, there's been massive ongoing selling and a lack of interest in the UK. And frankly, for overseas investors, things like Brexit don't help, even though the impact, as we all know, on a Shell or a BP is zero. But still, it affected the sentiment. And people just say, why bother? Why bother?
Okay.
It's a good question, actually. No, I was going to say, if you look at the UK market on a sector adjusted PE ratio relative to the US, it on average trades to Edmund's point of the 3 PE point discount. I think it's probably to do with the return on equity being lower in the UK market, I reckon, than the US. I don't know, because we haven't done the stats. As to the oil point, it's a very good question as well. It's part of that, but I'm sure there's something else going on that no one seems to be able to put their finger on.
Okay. We just let's just talk about the multiples. If we're still relatively sort of bearish on the economy for next year, what is a fair multiple? What's your view, Patrick? If you just kick this one off, because we've got the US is trading at an average of about 17 times, split obviously between the Magnificent Seven on round about 26. I think the rest of the market, the 493 on about 16, but the UK is on 10, which is less than its historical sort of average. What's sort of like fair value if you build in a sort of like a yield of sort of 4 or 5% 10-year Treasury into the mix?
Yeah, so on our measures that we look at, U.S. companies are trading at about 70th percentile, meaning 50th percentile is where everything is in line with their 40-year average. So 17 and change PE versus a 16 and change 40-year average. They're slightly expensive, not massively so. The profit margins are obviously very elevated, so I think those kind of premium multiples are justified to some extent. For the MSCI world, it's the same kind of thing, but it's 60th percentile on most of the measures. So the US is where the excesses are, the rest of the world slightly cheaper than normal. And if you don't have a recession, I don't think there's big risk in equities. We're underweight equities in all of our strategies right now because of what are pretty compelling returns in fixed income rather than a pretty dire outlook for equities for me. The most expensive companies in the United States have come off since our last call, probably 6-7% since we did this last month. Still expensive, but I think we're going to see some good earnings from them in the coming days as well. So a lot of the indicators are where there's weakness is what's going to happen. But the quarter that's happened, everything should point towards good numbers from these mega cap companies, I think.
Okay, we'll come back to that a bit later on the mega cap tab. Just on that mid cap point, Chris, let's just sort of like probe that, because one mid cap sector, particularly in the UK, that's been built, it's really sort of been battered of late, is the UK house builders. What's your sort of view on the housing market? Because they all trade at around about 10, 15, 20% net tangible assets, but they've got huge mountains of cash to get them through even a tough patch.
Yeah, I think they're terrific stocks. I mean, I don't know exactly when they're going to trough in the next 6 months, but I think they're going to do really well on a 3 to 5 year basis, because the UK housing market, what's interesting about it is you can jack up rates as hard as you like by the Bank of England, and the market's weak, it's going down, it's soft, there's no activity, but it's not crumbling. This is not the GFC. This is simply a housing market where interest rates are too high. Housing is temporarily unaffordable for a lot of people. It's the old stat that actually not that many people have a mortgage anymore. I mean, quite a lot of people do, but not that many compared to where we were. I think it's about 10 million households or something, which out of 30 odd million households is quite low. I think 12 million, something like that, own their house outright. And the rest of them, of course, are renters. So it's not killing the housing market. And what it means is when inflation dissipates, and I sort of don't agree with Patrick on this, I think inflation's moving out of the system fast, and it's going to surprise us how quickly it moves out. And I think that started in the States, and that'll turn up in the UK and Europe. And when that happens, the Bank of England's going to cut rates. And that's going to be great for housing stocks. It's going to be great for land speculation, which is what home builders are. They're speculators in land. And once the land starts moving up in price, those stocks will do very well. So yeah, you're right. They've got a load of cash. They've got a load of land. They're gonna love a rising housing market in the next 2 to 5 years. So I don't know when they trough in the next 3 to 6 months. Housing's going to go down very near term, but at one point it's going to hit a floor, and the bank's going to start cutting it. They're going to be the stocks to own.
I'm going to put you on the spot here then, Chris. So when's Andrew Bailey going to start dialing down interest rates from, he's got, I think it's the meeting, next meeting is on, it's a week Thursday, I think it is, and it's currently 5.25%. So when's he going to start reducing that below 5?
Well, the central banks are getting there. They're getting to the first step towards that, which is they're stopping the raise. They're across the West, they're getting to the point where they're not going to raise anymore. And we're pretty close to that point, I think, in the UK, if not there already. And then, of course, the average number of months between the last hike and the first cut is, it depends how you measure it, but it's sort of 6 or 9 months. So, get into the first half of next year, we'll be cutting, I would guess.
Yeah, that'll bring sort of like cheers of jubilation, I think, to the mid cap and the small cap sector. Now, Edmund, one area that's kicked off the Q3 earnings season so far, and obviously you've got a great insight in what you do, is the banking sector. And it seems they've put out some pretty decent numbers, most of them beating at the quarter, certainly not decreasing their full year estimates. They've had very strong interest income. The net interest margin has been maintained, and they've had less non-performing loan provisions as well than people thought would be, worst case. What's your sort of view on the banking sector? Because the stocks didn't do anything on the back of that.
But of course they didn't, Paul, because we're at the sweet spot. In a sense that you've had, let's say, central banks have raised interest rates. And for retail banks, that's good news, right? They make more money than net interest margin, as you pointed out, particularly in Europe, when you've gone from a negative deposit rate not so long ago to 4% deposit rate today, which is very highly positive. And we know that whatever regulators and governments do, banks drag their feet. We all drag our feet in raising deposit rates to where they should be to fairly remunerate savers. So of course that net interest margin temporarily looks very good because you jack up the rate to loans that you charge. You don't necessarily pass all of that on to savers, or if you do, you pass it on with a very big lag. You're slow to pick up those deposit rates, and so of course you make more money in the meantime. However, as you said, we haven't had the full impact of those interest rate hikes on the real economy, particularly in the US. So US banks have benefited from a boost in net interest margin, but have not had to suffer rising debt charge-offs against bad debt, because they haven't seen the bad debts go up yet, but they probably will, particularly if Chris is right and we see recession sooner rather than later. You're going to see the smaller business segment suffering, and that means that bad debts will rise, and then the charge-offs, the provisioning will have to rise. So that will eat into, and banks they're not stupid. They've signaled that with their guidance. JP Morgan are not very bullish on their outlook. They say, yeah, numbers are great today, but don't expect them to stay this great. And I think that's a story for American banks. European banks probably a little bit better, but not hugely better. But bear in mind that interest rates have not gone up as much in Europe as they did in the States. 5.5%, okay, 5.25 in the UK, but across the Eurozone, you're at 4%. So that helps a bit. And secondly, we're further through the slowdown process already. So I think, the bad debts, if they creep in, they'll creep in. But we'll get to see the hit sooner rather than later in the UK and Europe, whereas in the US, it might take a little bit longer. But overall, the numbers are good, yes. They are cheap, they're paying good dividends, but there is that sort of lingering question mark over to what extent will provisioning rise. Obviously, the optimists will say, well, not that much, because this is a strange economic cycle. Actually, we have a lot of a buffer, bizarrely, for small businesses, for consumers, that we haven't had before, or at least, we're not as overextended. But still, provisioning will go up.
Yeah. What about your view, Patrick, on the sort of the banks and also the house builders? Because obviously with oil, you think these are value plays at low valuations with M&A. But these ones fall into the same bracket in extremely low valuations. But are they value traps rather than value plays?
So I don't have a position in the house builders. My biggest short across our short portfolio, though, is our property companies, real estate companies. So British Land, China Vanke, Vonovia, Simon Property. The higher interest rate environment is pretty terrible environment, and you've also got a lot of big picture things about Simon Properties as shopping malls. People are shopping from home. British Land has people working from home, and residential prices are just, in Germany, they got very expensive versus income levels. You've got much higher interest rates. It's not a mortgage economy, but house buyers don't buy with mortgages, but Vonovia is incredibly leveraged. So you do have implications from that as it rolls over its debt into higher yielding debt. That really impacts profit margins. So with that being my big picture view, I'm not chasing the house builders right now, because I do think it's a pretty tough backdrop. And on the banks, I'm actually slightly short banks right now. We're short Bank of America. We're short Morgan Stanley. I own Citigroup. I don't own the Swiss banks, but actually those I would be inclined to buy right now. I haven't done it yet, but I think that's one area where you are going to move from negative interest rates into zero interest rates at some point, and that'll get rid of a big headwind. And UBS has a monopoly position right now, which it's going to monetize through higher profit margins. So I don't have big positions in the banks. I get paid 11% to short Morgan Stanley because I buy 11% worth of Morgan Stanley bonds and I get a 200% exposure. So when I short something for $1, I get the dollar that the client gave me to short with, plus the dollar I sold Morgan Stanley on. So I'm getting 11% carry to short Morgan Stanley. So if it doesn't go up 11%, I'm making money by shorting it right now. So that's because of the attractive returns I'm getting from the cash on almost risk-free assets at the short term on these big AA rated banks right now. So it is pretty punitive to be long when you have an 11% cost to short against it right now. And I don't think there's huge upside in the banks.
Yeah. Okay. Now, Chris, can we trust the balance sheet to these banks in terms of I know we've talked about the unrealized losses on their securities, their assets. Yeah. But frankly, most of their balance sheets are private assets. They're loans to businesses, which are done at sort of like 1, 2, 3%. And if you had to reprice those or mark to market, then they're going to have a big bath on those, even though they're not actually a security. And I'd class that as an example would be Metro Bank. It's going to try and sell £3 billion of its retail mortgage book. Good luck with that at £3 billion. It probably isn't going to happen because when you mark to market a private, can we trust the bank balance sheets at the moment?
Well, that's quite a sort of generic question. I mean, it depends which ones you're looking at. I mean, are you talking about the UK, the US, or
just generally,
Western Europe? Generally,
because we've had 15 years of ultra low interest rates at 0%. Anybody who's got a fixed interest on a loan they've given out is going to be less than 5% currently. So if you had to mark that along with in line with other securities, it's going to give you a massive hole in your balance sheet, presumably.
It depends where you. I mean, the first thing you've got to say is, I mean, banks have spent 15 years in the West mostly rebuilding capital. Now that's not every country, but they've been trying to put their house in order. Yes, of course, you're absolutely right. They made a ton of loans to zombies, to commercial real estate companies that Patrick talks about, all of which are going to be rolling over at higher rates. So there's definitely a lot of stress in certain countries and certain sectors. Commercial real estate is undoubtedly one. Sweden is a country where there's a lot of stress in resi and commercial real estate. You could say the same about a lot of Scandinavia. But I'd still say that a lot of the Western banks, and again, actually, you've got to talk about the regional banks in the US, where there are a ton of problems because of their loan book, because their deposits are leaving, and so on. But I still think there's a lot of Western banks, particularly big ones, where they're in pretty good shape. And yes, they've got some challenges. Of course, there's going to be rising delinquencies, some rising charge-offs. But a lot of Western banks, if you look at the big Western banks in Europe, particularly take the UK, I mean, the vast majority of their loan book is mortgage debt. So if you don't think the housing market is in the sort of damage it was in the GFC, then there's a pretty good chance they can weather this. So, I mean, I come back to Lloyds. I think Lloyds, I always talk about Lloyds because it used to be such a boring conservative bank. And then they bought Halifax that kind of made it 10% more exciting. But it's still pretty conservative and boring, I think. I'm not a banks analyst, but they got more capital and they know what to do with. And I think what you'll find is a bank like Lloyds will start doing very, very well when they start cutting interest rates. And in fact, what I love about Lloyds, and we're probably going to come on to this, but the best chart of valuation out there, you asked how cheap's the market. Magnificent Seven are very expensive. You've already mentioned them, the big cap tech stocks. A lot of the UK is very cheap. So take Lloyds, where you got a lot of history, put it against Microsoft, where you got a lot of history, and Lloyds is trading at a 17% PE ratio relative to Microsoft. It's only ever done that twice in 35 years of history.
Right, actually, 6 times versus about 30.
Yeah, exactly. 35 years of history. Once in 2008 when Lloyds was falling out of bed and its earnings were a disaster. So you didn't want to buy it then. And the other time was March 2000 when Microsoft was topping, tech was topping, and the UK was troughing. That, I think, is the best. That's the only chart you need to look at. That tells you everything about the next 2, 3, 4, 5 years. And it tells you everything about Lloyds. Lloyds is not as it was coming into the GFC. It's a completely different setup. It's ready to go. It's waiting for lower interest rates. And then it's going to do very well as a stock.
Yeah, well, I think if the top brass at Lloyd's put an AI spin on it, then it's got a chance of that mean reversion. Now, moving to Edmund, to your specialism in all things AI, the big tech, they're starting to report now. I think we've got Microsoft today. Alphabet today, and then I think later we've got Amazon and Facebook or Meta later
Yep.
in the week, etc. So Edmund, this is not you, Chris. So Edmund,
no, I know.
okay,
I know.
Edmund, in terms of the what's your latest view on big cap mega tech? Because people are pointing it as a defensive play because of the huge cash on their balance sheet, and are therefore sort of like, saying that the earnings estimates, shall we say, the PE ratios are justified at pretty much sort of like anywhere between 25 and 30.
Yeah, I think we've heard this story before in 2000. I think we've heard this story before with the nifty 50s. People always find ways to justify things, and high valuations, and there's always another creative explanation. Now, look, the interesting thing about these bubbles, or these excessive valuations, is that there is always a foundation of truth in the story. The problem is just how far do you want to go, and how far do you want to ignore the risks? And I do think, yes, they are quasi-monopolies in many senses, but there are always risks. For instance, the Google quasi-monopoly of Google search on Apple iPhones could come to an end very soon, could be forced to come to an end by the regulator in the US, for instance. Now, that's a big source of revenue for Google. Google pays billions of dollars a year to Apple. So in a sense, both Apple and Google could be a bit of a loser. Apple would lose out on the sort of payment from Google. Google would lose out because they will no longer have that sort of quasi-monopoly on search on the iPhone. So there are threats from regulators in the US, in Europe, and elsewhere, number one. Number two, if we look at companies like Apple, there are also threats, for instance, to sales in China. Well, we can hear that the Chinese government is very keen for government employees not to have iPhones, and this seems to be spreading. And the advanced report is that the iPhone 15 model is not selling that well, particularly in China. So there may be some hiccups along the way, and I think I'm not so convinced that these high valuations are justified. I don't think they're that defensive because, again, when you look at the exposure of Meta or Google, for instance, to online advertising, well, it's still advertising. You can't tell me online advertising is impervious to the economy. That sounds counter to everything we know about advertising. It is a cyclical industry. Now, okay, there have been some structural issues. There has been a structural shift from, let's say, offline to online in terms of advertising, but still, there's got to be an inherent cyclicality. And I think Amazon, retail, again, we can see if consumption is going to slow down in the States, there's no way that Amazon, being such a large portion of consumption, can sidestep that completely. So I do think that while the results are probably going to be very decent, looking forward, I think there are still risks there that are perhaps underappreciated. And so, yeah, I'm not terribly keen to pay these very high multiples.
What about your view, Patrick? How are you playing the sort of the tech play, the tech sector?
So I'm still inclined to, like we talked about last month, selling put options on these, which is a bullish strategy, but not completely outright bullish. So buying these companies at better entry levels, it creates a forced buy discipline if there ever is a sell-off, and you get paid to get that discipline as well.
How much out, just percentage-wise, how much out the money do you put your price on?
NVIDIA, we've done it about 35% out of the money. Apple, we're about 6% out of the money. Google, similarly, about 6%. So I think Apple, Alphabet, I don't own Meta right now, but I would actually own Meta probably a little bit below these levels right now too. So they have sold off 6-7% since we were speaking last month, and it's not 20 times earnings anymore, Alphabet. It's not a ridiculous multiple. There's a lot of cyclicalities with these companies, but they are dominant market positions, growing faster than the market. And it is a very fragmented market cloud, but every customer each one of these companies have, the cost of moving their cloud business somewhere else is so disruptive to these companies that they can just raise prices every single 6 months or every 12 months when the contract rolls over. And it's huge pricing power in the cloud-based services of these companies. So there's nothing like a monopoly position because they all have very big market shares, but each customer is almost entrenched, and it's an ability to print money. And I think that is very attractive. So I'm not usually a bull compared to different panels. I'm usually a little bit more in the middle, but I think out of all the four of us here right now, I probably am the most optimistic and think clients should be thinking about how to get exposure to these companies if there's a sell-off.
Yeah. Have you bought any sort of value tech plays? I mean, and you haven't decided to go for Intel or there's PayPal as well, but
and we own PayPal, which is it was a value play when I bought it, and it's more of a value play now. So we're down about 20% on PayPal. But it is mostly at the higher end we own. We own Amazon, we own Apple, we own Alphabet, Adobe, and I think I'm pretty much 2% underweight market weights in these stocks in aggregate. So I do have exposures to them, but I'm not really overweight versus a benchmark.
Yeah. Okay. Let's just swap sectors then to all things sort of like in commodities and industrial metals and stuff like that. Chris, what's your sort of top level view in this area? Because obviously, if you're reasonably positive on energy, there's a cyclicality associated with that. Presumably, there's a cyclicality associated with the sort of the iron ore and the battery metals and this sort of stuff. But they've come down a lot. I mean, we're trading at sort of like high single digit PE for most of the big global miners.
Yeah, I mean, the thing you have to get right for these guys is what's going to happen to the commodity price as well as the fundamentals in the business. And we know that most commodities haven't had a lot of capex invested in discovering new supply in recent years. Capex has been going down, and so there's going to be a tightening. I think what's impressive is the way the iron ore prices held up despite the Chinese market for housing falling apart. I mean, Chinese housing market is extremely weak. Housing starts fallen out of bed in the last 18 months. And we haven't had the big policy bazooka yet out of China, although it looks like China is shifting from its policy of deleveraging to a new policy of reflation. So actually, that's quite positive for some of these metals, these industrial metals. So I think we're brewing towards a point where you want to buy these. They've been going down or flat for 12, 18 months now, and they are cyclical, as you say. So as we get into the sort of early next year, I think economies are going to start stimulated. China's starting to stimulate now. All of that's quite positive for these metals and these stocks, which are play on these metals. So yeah, I think copper's it's softening in the last month or two. I wouldn't jump on it now. Watch it play out, and iron ore sort of held in there. But again, I wouldn't chase it at the moment. But I think these stocks will provide real opportunities in the next 6, 7, 8 months. So not yet. I'd be a bit more defensive in portfolios at the moment. But the possibility is brewing, and it's going to be a good possibility because these economies are going to try and reflate at some stage in the next 6, 9 months. I mean, fascinating what Bitcoin's doing in the last few days. I don't know what's going on with Bitcoin.
You've been buying, haven't you, Chris? It's over $31,000, isn't it?
It's moving. It's a good liquidity indicator. I just wonder if it's telling you something about that steepening up of the yield curve, which I think is telling you you're moving towards a recession. And maybe Bitcoin's telling you, maybe Bitcoin's sniffing that as well. I don't know. I mean, I wouldn't want to overemphasize that point, but yeah, I think these metals are going to be good. I think they're going to have a moment that's going to be very interesting. Again, on a 2 to 5 year basis, it's all part of what we call the great global sector rotation. Tech's had 7, 8 years of really good gains, apart from 2022, and I think that's basically done. And the market's going to move on. Markets have fashions, sector leadership changes, and I'm pretty sure that resources will be part of the next wave. In fact, look, I mean, if you want to find a stock out there that's got a PE ratio that can double in the next 5 years, what do you want to bet on? I mean, do you want to bet on a resources stock that's probably got a single digit, low single digit, mid single digit PE ratio, or do you want to bet on something that's on 30 or 40 times? I mean, I know what I want to bet on, particularly if the prices are going to go up, the commodity.
Yeah. What's your view, Edmund? Because I know you're quite keen on you were keen on precious metals, but also battery metals, the sort of like the stuff, the copper and those areas.
Yeah, no change there. However, I would agree with Chris on the timing. Obviously, in the near term, people are worried about recession, right? And recession hurts demand for industrial metals. So that's the predominant factor right now. So, as Chris said as well, China hasn't really lifted off. You haven't had the big bang fiscal or monetary stimulus. You've had bits and pieces, but not enough really to light up the commodity sector. And I think that's what weighs. But I do think I would 100% agree with Chris that in the medium term they are going to be an excellent opportunity. Do you need to buy them right now? No, absolutely not. I mean, look at copper. You can wait for copper to give you the signal, and then you can start to move in. But I do think that's I think that the underinvestment we've seen in the commodity sector generally is obvious and will play out in higher commodity prices over time. There is this huge debate about whether we're in a super cycle for commodities or not. I actually believe on balance we probably still are, and we've just had a bit of a bear market cycle within the longer super cycle, because obviously for the economic reasons. So for now, I would say stick with the energy patch. I think oil and gas is still a very good place to be. I think uranium is still a very good place to be, and I think these battery metals will be a very good place to come back to in the near future. Maybe not necessarily today, as Chris said, maybe in a few months. But I think if you're looking with an investment horizon for the next few years, then this is a very interesting opportunity that we're going to see before us very soon.
Well, I'm going to put you on the spot here then, Edmund. What's going to be the signal that tells you that copper or these battery metals is going to be the time to buy? Is there one, or is it?
Just stick with the copper price. It's as simple as that.
Right, okay.
I think the copper price is good enough. It's probably the cleanest signal you're going to get.
Dr. Copper will tell us. Dr. Copper will tell us. Okay,
Yeah.
Right. Well, let's go around the horn of just sort of like investment ideas. I know, obviously, you've talked about this one, Patrick, in terms of the tips, and you've sort of sold your gold, and any other sort of like areas that investors might want to sort of like put the slider all over?
Tips, mid-cap oil and gas companies from Canada, and shorting Japanese bonds. They're at the limits of what they can do with their yield curve control. Basically, they're pushing a string now. They've bought all the bonds they can. They're giving free money to banks to buy Japanese bonds. It's not going to work with a higher yield environment everywhere else. You're going to have a very weak yen, and yield curve control is just going to lead to a yen that's too low for the Bank of Japan to accept. So I think shorting something that costs you 0.8% to short, risk reward, it's very skewed in your favor to short that right now.
And if you do see that break of the yield curve control, and say the 10-year JGB goes above 1%, maybe even double to 2%, is that going to have any sort of ramifications elsewhere with liquidity and bond yields in other areskier
It would be a breaking of a carry trade, basically, that a lot of people borrowing in yen and using the zero interest rates there to fund riskier purchases elsewhere. So when that does break, you probably will have some risk assets that are based on a carry trade suffering from it. But it's for me, it's just a very cheap short with the odds skewed in my favor.
Yeah. And Chris, have you any sort of top level that people should have a look at into sort of like key investment ideas that you would think about?
Yeah, I mean, I think on a 6-month view, I'd go the other side of gold from Patrick. I mean, I'd be a buyer of gold, and I'd also be a buyer of consumer staples. I think both of those are going to outperform the market over the next 6 months, because gold loves it when the market starts to price in rate cuts. So if the macro view is correct, gold is going to fly. And it's consolidated really and sort of not done that much for quite a while. It's sort of been a bit volatile within a range, but I think there's enormous potential for gold, and it will be a good protection. And then staples is a very cheap sector that's a bit of a play on bond yields. So if you like tips, yields, and you think nominal bond yields are going to come off, staples are probably going to outperform. If you think we're going to have a recession, staples are going to outperform. If you think the market's going to sell off, staples are going to outperform. So there's a lot to be said for them, and I think they'll do well as a sector over the next 3 to 6 months. So I'd be defensive. Gold, staples. You could buy treasuries. I think all the stuff Patrick said was quite interesting. Yeah. I don't know about the Japanese yields. That's a good question, but it's an interesting risk reward.
Yeah. Okay, good. What about you, Edmund? Which was sort of your preferred sort of like areas for investors to have a good look at?
As I said, I'm still sticking with energy. I still like energy of various sorts. I think the exposure is cheap. I think the exposure is interesting. And again, this comes back to the underinvestment point that Chris had raised earlier on about commodities. That applies equally well to all forms of energy. There has been underinvestment. And it's interesting that even though the US economy, the US has seen its oil production picked back up to $30 million a barrel. I think they're going to struggle to do more than that because, again, we haven't seen a lot of oil rigs being used. We haven't seen a lot of new shale wells being drilled. And on top of that, don't forget that these shale oil wells deplete very quickly anyway. So you've actually got to drill lots of holes just to maintain current production, never mind increase. So I think actually the sort of boom that we've seen in US growth is oil in terms of oil production is going to be challenged, which is a pretty good backdrop for oil, I think, and for uranium even more so. Otherwise, I would equally look at tips, as Patrick has said. I think 2.5% real is extremely attractive for a more conservative investor right now. Otherwise, yeah, it's a tricky market at the moment, and I actually would say that the focus on quality. Chris mentioned consumer staples. I would say the focus on quality usually plays out. What we should remember about quality when applied to stock markets is, first of all, it does tend to cushion the blow when markets fall, but also when the recovery comes, quality as a factor recovers pretty well, faster than the market. So your time to recovery from the bottom is actually quicker with the quality factor than with the overall market. So I would say, again, think about areas of quality. The luxury goods have been beaten down to healthcare. We've talked about staples. These are all quality areas that maybe have been beaten down somewhat and are interesting right now. Okay, good. Now, again, just wanted to close on. We've had for interest rates at sort of 5% plus, and if we are in this higher for longer type environment, what is next going to break? We've had the banking crisis in March of this year. Is there going to be a hedge fund? Is it going to be another bank? Is it going to be what else? Who's going to be the next sort of shoe to drop with this sort of high interest rates with the leverage? What do you reckon, Patrick?
Property. It's just
Okay.
high interest rates. Property is that's the place you really want to worry about, I think. And there's going to be cracks there.
Office property, commercial real estate, office property.
Everywhere, yeah. So I think commercial property, shopping malls, residential property in Canada, residential property in Germany, very expensive. And office property pretty much around the Western world. I think all of those things have big risks with high yields. Cap rates go up and rental yields, it's going to be hard to hike prices when demand is slowing.
Yeah, and who has the debt on that? Is it the banks or is it the effectively the non-traditional lenders?
Well, it's the companies themselves that they've issued bonds as well. So the banks have some of it, but the bonds from these companies, Vonovia, I'd be very worried with.
Okay. What about you, Chris?
Well, I think those are all very valid comments that Patrick makes. I would concur. I mean, there's a lot of shadow loan books out there that no one really talks about because it's very difficult to get information on. I suspect some of them will break. I'd throw out there, I don't really follow single stocks, but I have this sneaky suspicion that Charles Schwab might break. But if you look at the share price, I was looking at it this morning, it's back at its lows from the banking crisis, which I think is quite something. And my left of field is Tesla. I don't think Tesla's going to go bust, but I think the share price is going to break. It's just broken below its 200-day moving average. It's a very good car company run by a genius, but it's also been a sort of a cult stock, and it's got caught up as much as any of the other Magnificent Seven in the bubble-like behavior in some of these tech stocks. So I think that's going to unwind. I mean, it was only back in 2018 we thought the stock might go bust, and of course, in many ways, it's a slightly different company, but in many ways it isn't. So I think it's far too expensive a stock, and I think that's a good short. I'm not saying it's going to break, but I think it's a great short.
Yeah, I don't think Kathy Wood of ARK Investment would be too happy if that proves right. But I'm with you. It's a sort of like a battleground stock. What about you, Edmund, in terms of potential things that could break?
God, there are always so many possibilities, and anything leverage, as Patrick said.
Yeah.
Real estate leverage obviously is a big factor. I would say also private markets, because we talk, the private debt. One thing that does concern me a little bit is how many fund managers are, trying to hawk private debt as a new asset class. It's like, whenever someone does that and you see such an explosion of interest, and yes, the interest rates are high, but if the interest rates are high, it also means the risk must be correspondingly high. And what worries me is when people chase the interest rates and then forget about the attendant risks. And I just wonder whether some of that isn't going on right now. And so it won't break right now, obviously, but I think at some point in the future, there may be some sort of mis-selling issue that may pop up, particularly around private markets and private debt.
Yeah, no, I think you're right. I think everybody's in terms of, there's a day of reckoning happen here. And if we keep rates elevated for longer, at some point, these guys have got to roll over their low interest rates. And whether that's commercial debt, whether it's companies, whether it is or something, they go from 4 or 5% to 12, 13, 14, which I think is the sort of like the basic sort of like, tier senior debt that the private equities are offering a lot of companies, which seems to be the default level. So you're almost doubling your interest bill overnight. So yeah, it's something to watch. Okay, well, thanks very much, gents. And we'll have a big Christmas edition last time at the end of November. Well, and I'd be really interested to hear your outlooks for 2024 because we've had an up and down year so far. Not too bad if you've been in the right spots, but pretty awful if you've been in the small and the mid caps and in the house builders. So thanks again, guys, and look forward in touching base in about a month's time.
Thank you. Thanks a lot.
Right.